Good afternoon, everyone. Ian Matthews from PKF, along with my fellow presenter, Darren Shone from PKF Newcastle. I'm from PKF Sydney. Firstly, I'd like to say welcome to everyone on the webinar, and on behalf of Darren and I and PKF, thanks to you all for making time for attendance at this webinar. First for me, bit of an old school presenter, prefer people in a room, but we'll see how we go with my first ever webinar. Jermaine, next slide, please. So what we're setting out to do today is run through as much content as we can on the payroll tax provisions leading into annual payroll tax returns coming into 30 June year end. We've got a chock full lot of information to get through. And what I'm hoping is that people will probably be able to pick up 5 salient points as we go through this presentation. There will be a lot of content, and a lot of the law is settled, and a lot of people will know a lot about a lot of the areas we're discussing. But there's certain issues that we'll run through, recent developments, contractors and grouping that continually give people stress. And we'll also just try and point out where you can go and look for information, what contact points, what resources there are. So what the scope of the presentation today will mainly be about the New South Wales provisions, but obviously payroll tax is administered on a state and territory basis. They tried to harmonise arrangements back around 2007, but there are still some differences in each jurisdiction. In looking at payroll tax, it's sometimes worthy to look at the past. Where have we come from to see where it's all going? And it surprised a lot of people. It was introduced as a temporary measure in World War II to finance a national endowment scheme for the children of fallen soldiers. It was meant to be a temporary measure. In 1971, they passed control of the payroll tax from the Commonwealth to the states and territories. In 1975, they introduced the grouping provisions, which we'll speak about more, as an anti-avoidance provision. And around 1985, most states and territories introduced the relevant contractor provisions, which we'll also talk about a bit later in the presentation. The legislation has stayed basically static since that time. It's a fairly simply written legislation in terms of the words in the legislation. It's written for the old world. It's not really written for new world and new world arrangements. So a lot of the interpretation of payroll tax and how it applies comes down to what agreements say, what arrangements are made, and then applying these provisions essentially written back in the 1970s to modern day business arrangements. From the 1990s onwards, the payroll tax base has been expanded from basically salary and wages. They picked up fringe benefits, and then they got a free kick when entertainment on fringe benefits was included in the fringe benefits tax. Super contributions, which has been a growing area. Payroll tax is on all superannuation contributions, which Darren will speak about later. And then one of the later changes they made towards the end of last century into this century was payroll tax being imposed on employer share schemes. Around 2007, the states got together and tried to harmonise the administration and the legislation between the states and territories, given that a number of businesses and consultants and stakeholders were frustrated by the lack of consistencies between states and territories as to both legislation and practices. So that's where we're at the moment. One of the fantastic resources for taxpayers not only the State Revenue Office websites, but there is an overall website, Payroll Tax Australia, which Jermaine is just going to click into now. And this has a wealth of knowledge about questions and links to different states and territory revenue websites and the like. One particular link in this is in the educational library, which has videos mainly about a lot of the issues we're talking about today. So we're trying to get through this in an hour, but there's a contractor provisions and grouping provisions video that the revenue officers have put together. They last for about 50 to 60 minutes in their own right. So a lot of detail that people after this session can go and view. As I say, we probably won't have time for questions, but if people do have questions, there are resources on various websites. Darren and our email details are at the end of the presentation, or your local PKF contact. You can contact them, and if they need to talk to Darren and myself, we can do that, arrange that internally. One thing that surprises a lot of people, if you look at the Australian Bureau of Statistics, this little table, you'll see payroll taxes in 21-22 were worth just over $27 billion to the states. So all the talk where people urge the states to get rid of payroll tax and replace it with another tax, it's a fairly big ask in terms of replacing that tax revenue. One of the other things we typically see is the compliance obligations that employers and businesses put around fringe benefits tax. If you look at the ABS figures there, 21-22 collected about 3.2 billion. Payroll taxes collected over 27 billion. Businesses generally put a lot of effort into FBT compliance, don't generally put a lot of effort into payroll tax compliance. That's just the way it's evolved over the years. And what we'll see during this webinar is the revenue officers have become very good at data matching with ATO information, looking up websites, looking up social media and the like, and payroll tax compliance probably will become a bigger compliance effort in the years going forward. The other interesting point is if you look at the ABS statistics on taxes on property, the dreaded stamp duty and land tax, those two only raise about 15.6 billion as compared to payroll tax of just over 27. So it is a very important tax for the states, and they are very focused on collecting it and conducting reviews and audits. And again, we'll talk about that later in the session. So with that introduction over, I will hand over to Darren for the first part of the presentation.
Thank you, Ian. With payroll tax, it's often something you think about once a year, where you do your monthly calculation and you fill out your paperwork and off you go. But you need to be aware of what's changing in payroll tax, and when there's been some pretty significant changes, particularly for larger businesses that are structured in the way that some larger medical practices and some dental practices and the like carry on business. And we're seeing that as a general trend across Australia with the ATO and with the revenue officers. They're really sort of honing in on some provisions, and they're looking for some test cases, and they're pushing ahead with a view that is contrary to what people have long held was subject to payroll tax or had income tax issues on it. And I've given some examples there, which I'll run through in a moment. But they're looking to push to establish this view, and it's a view that they've been simmering away for a while, and they're just chipping away at it. The most relevant one for payroll tax is the medical practices and payroll tax. Now, it is framed as a medical practices approach because that's what the case was about, but I'm seeing it across all allied health type services. So I haven't actually seen audits and assessments issued in sort of dental and other related practices as well. So it is very real. It's not just a position that's out there and stuff you might have read on blogs and the like. It is actually happening. Then, you know, just as a side on income tax, we have these issues coming out of the ATO on this thing called 100A, which people will be aware of, you know, when they've got trusts and how that all works, and then lack of guidance in some cases where the ATO have won. And then we have for like professionals, again, with doctors and medical, about the practitioners paying more tax on their share of distributions because the ATO views that they should be paying more tax. Now, in some of the cases, they don't really have law. They've got some cases or they've got a view and they're pressing on. And the problem is that we have to prove that they're not right, and nobody wants to be the test case. So if we look at the first area, which is because this seminar is about payroll tax, we'll look at the contractor provision, and it's sort of a sign of things to come, is that we really need as a focus for payroll tax to look at contracting, because it is a modern business practice. As Ian has said, when the laws were written, the level of contracting that we have now wasn't there when the laws were written. So they're trying to interpret it because there's been a shift away from employment to contractors, and the officers of state revenue are saying, well, we're losing revenue. It's an important revenue item, and Ian has highlighted. So we need to be able to include these in to keep the payroll tax base there. So they're looking at that because they're essentially employees that are coming out and contracting. So we'll go to that in a second. Then we'll look at another area, which we've had some issues with audits on with employment agents and how that sort of works. And the fact, the main point there is there's no contractor exemptions available if the Office of State Revenue goes down that path. And then we'll dive into who is an employee contractor and some of the rules, because sometimes it's a bit grey. And just because they're an employee for tax doesn't mean they are for payroll tax, or more commonly, they're employees for payroll tax, but they may not necessarily be caught for super guarantee or other ATO-based rules. We can go to the next slide, please. So just with financial planners, and this is sort of a sign of things to come, is that the New South Wales Revenue issued a Commissioner's Practice Note on AFSL licence holders and their authorised representatives. If you just click on that, please, that link. If you just scroll down a bit. So I won't go through all the detail, but basically what they're looking at is they're saying, well, if you walk into some of these financial planning practices, they're branded as a brand that you all know, right? And when you walk in and you look in and you see the brand and the reception, and then there's offices like any other office that's a big company, and then the financial planner will come out and see you. Now, quite often those financial planners aren't employees, they're companies, and they're operating as a contractor. So they're getting a fee. However, the way that the legal arrangements work is that you've got the head agent who's providing as the license, and then these guys are all providing services to them, but also providing services to the clients. And their view is that these are relevant contracts and they're caught for payroll tax. So they're deemed employees and they're subject to payroll tax on the commission that the agents get. Now, then they run through all of the tests in this guidance. But so if you look at it, not so much, if you want to refer to it, not so much and focus on the financial services, but look at the types of arrangements and types of terms that I look at, and you will see what they're trying to pick up in terms of the contract revisions. And then they look at the exceptions, so that these contractors can be out if they fall out of the payroll tax contractor exemptions. And there's three that they mainly look at, but the main one they look at is providing services to the public at large. However, the OSR view is that they're really providing services to both the head entity with the license and to the client, but they say as long as they're providing services to the AFSL holder, then it's a relevant contract. And then they have to be, so they're not solely providing services to the public because they're doing it through the AFSL. So they get caught up. But if they are genuinely working for a few of these AFSL holders, then they can escape the contractor provisions. But that's contrary to the model where the larger brands are tying these agents in so that they've got a bigger revenue base because they may be listed, for example, and they want them to work exclusively for them and not solicit and not work for other authorised representatives and the like. So that's the general trend in that. So if we jump out of that link now, and there's some good examples in that link too that you can see. If we jump into the other side of it there, and we've got the medical practitioners issue. And the structure is very similar for their businesses. And you'll all seen them with all the medical centres or dentist centres or even chains of pharmacies. And they're structured in a way where they operate this big practice, and you come in and you can see a doctor, and if your doctor's not available, you'll see another doctor. If you come into the dental practice, you'll see your dentist, but you'll see another. Again, they have the agreements with the head entity to provide the services for them. They have restrictions on trading elsewhere. They have to book in leave and the like. So there's a certain level of control. They're given hours of work, they're given rosters, and they're given things like that. But they're essentially the medical practitioner, either as a sole practitioner or as a company, providing the services to the patients. And the doctors are, because they're doctors, they're providing it under their service provider number, which is something that only an individual can have. But they assign their rights either to their own company or they assign their rights to the head entity that runs the medical practice. And quite often that practice then does all the administration for the medical professional and receives the fee, claims the Medicare rebate, puts it all into their central bank account, then keeps 30% for themselves and pays 70% out to the doctor. The percentages may vary, that's not important, but that's what they'll do. And so the revenue authorities have jumped onto this, and the Thomas and Naz decision was about that, and it was held, yes, they're relevant contract. Now, they picked up all of the doctors where the practice received the 100% of the fees, retained its 30% and paid out the 70%. Interestingly, they didn't include in the assessment the doctors that received the Medicare and just paid 30%. And so, but in the case, the Office of State Revenue was arguing that they're all bought by. So there's an argument about that you can sort of fix this issue with flow of funds, but the Office of State Revenue view is no, it doesn't matter that the doctor or the medical practitioner might get the money and pay it to the service entity. They'll regard it as a deemed payment for the 70% that they keep. But it is uncertain, and it's something we need to be wary of. So it's a watch this space, but the key points are that the medical practitioners can be contractors, and you can apply the same reasoning to any type of business where there's this aggregation of people into one bigger business that's under a common brand. They can be excluded if the contractor exemptions apply, and flow of funds doesn't necessarily solve the issue because of this Section 46 and Section 51 in Queensland. And the first state to actually issue guidance has been Queensland. And we'll jump into that guidance. Now, New South Wales is going to issue guidance. I have seen the draft. It's very similar to the Queensland one that's been issued. I think they've been talking to each other. I don't know, they've been talking to each other, actually. And it runs through all of the issues that I've just run through there. And so they're talking about, if we just scroll through a bit, Jermaine, they're talking about them being, there's a medical centre that promotes medical services to the public. So you can see the sections there. They talk about the liability for payroll tax. You just scroll up a bit, Jermaine. Yep. And then they talk about how the relevant contractor provisions apply to a medical centre, about whether they're separate businesses, is there a contract and is it a relevant contract? And they run through the tribunal decisions, and then they talk about doing an entity, so a company interposed doesn't solve it. And then they look at the exemptions. So the main exemptions they look at, which are similar to the financial planner ones that I mentioned before, is providing services to the public generally. So in the case of the financial planner, if they ran their own business on the side and they weren't tied exclusively, there's a possibility that the AFSL that employs them some of the time can get out, 90 days or less, not if they're full time, and services performed by 2 or more persons. If they employed other people, they may be able to escape the liability, but they have to be principal work. Same thing here for the medical practices, is that we need to think about whether those exemptions can apply, and that's the main thing. But the model is to tie the doctors into that medical centre because they want all of the patients to come to that medical centre, and if something happens to the doctor, that they'll retain the patients. They don't want the doctor practicing somewhere else. So it may cause a change in the model. And if you contrast the arrangement to something very clear that's not caught, is that I went and saw a specialist the other day, and whilst the specialist was in a building, it wasn't branded as some medical practice. It was just specialist rooms. And I walked in to see the specialist, and there was no central reception. Each specialist had their own suite of rooms. You walked in, they had their own reception area, they had their own waiting room, and they had 2 consulting rooms, one for the patient they were seeing currently and one for the next patient. And they're simply paying rent. So it's a tenancy model. So that kind of arrangement doesn't fall into the contract provision. So we just need to be mindful that, especially for these larger aggregated businesses, where people are getting the benefits of sort of a larger business, is that the contractor provisions are problematical, and it's especially in the case of financial planning and medical services, which is your full suite of medical services. Now, interestingly enough, in Queensland, there is an amnesty because this is a change in view, and that they will give, if you come forward, they'll give you an exemption for payroll tax for the last few years if you come forward, but it's at this stage limited to doctors. It's not available for other medical practitioners. Now, there are theories as to why that is, but at the end of the day, that's where it is at the moment, and hopefully that'll be extended. There's no word of an amnesty in New South Wales at the moment when it does come out, but they haven't issued their guidance yet. But just beware, that is probably the hottest topic in payroll tax in New South Wales at the moment. You can jump to the next slide, please, Jermaine. Another issue we're seeing is the interpretation of the employment agent provisions. And we just need to be careful with this because it looks like a contractor arrangement, right? So you've got a company that's sourcing labour for another business, and most commonly it's in the cleaning, security, supermarkets with their trolley collecting, and in the mining industry. And these employment agents are sourcing the labour that they provide to the mines. They look like employees of the mines. They wear all the same sort of gear, but they're actually employed by these other organisations that find the labour that they need for the day and then send them somewhere else. And what we're finding with these is that these, if they go down this path and they fall in here, that all of the payments to these contractors of these employment agents are caught by payroll tax for the employment agent. And the problem for these businesses is that they're not relevant contracts, so they can't rely on the contractor exemptions to reduce the payroll tax or remove people from the pool. So we've been through audits where the whole audit was proceeding on the basis that they were relevant contracts and sorting through which ones were caught and which ones weren't, analysing it. And then the 1 minute to midnight, the Office of State Revenue Auditor said, oh no, sorry, no, they're not relevant contracts at all. They're actually employment agency contracts and there's no exception. So the whole amount of the payments are caught. So it becomes a bit of an issue. So another area to focus on is to look at your arrangements and just make sure that you don't fall into these employment agents. So you want to make sure that you're not into this area. And there is some guidance. I won't get Jermaine to click on the link, but there is a link there to a Commissioner's practice note on how those provisions actually work. And so you can get some background on that if you want to read it. Apart from the resources that Ian mentioned before on that Payroll Tax Australia, there's information there on that as well. If we jump to the next slide, right? Now, one of the other areas that's, and again, it's sort of the contractor area, is just generally to understand who's an employee and who's a contractor. I'll skip through these fairly quickly because we've got some other content to go through. But we've outlined there that you need to not assume that an employee is an employee for all taxes. There can be different interpretations, particularly around super, and there are law cases that are decided to say when super applies and when they don't. So anyone that's on salary and wages will be an employee, and we need to see if there's an employer-employee relationship. It's not so much how we describe it, it's more about actions that we need to be wary of. And then, as I mentioned before, the independent contractors are brought into payroll tax, where they're basically labour payments. So they're deemed employees, okay? So we need to understand if they're contractors or employees, and can we get them out? Because employees, we don't have exemptions. Contractors can have exemptions. We're going to talk through that. Joanne, if you can go to the next slide. So for employees, basically we look at control and integration tests. Now, I won't go through these in too much detail, but the focus with all of this revenue stuff is if it looks like a duck, and quacks like a duck, it's probably a duck. So if they come out and it looks like they're employees, it looks like they're integrated, it looks like they're controlled because of this sort of master-servant type relationship, they tell them when to work and who to work, and if that person has to provide the job. While they might be able to delegate under the contract, they can't practically. All of these things to be considered. There's not any one thing that's determinative. It's looking at the entire relationship to determine if they're employees. So you want to be looking at your arrangements and saying, well, is this person really under control or not? Because on a review, that's what they'll be looking at. And they will include them and they will penalise you if they differ with the year. I think it's over to you now, Ian.
Thanks, Darren. The next 2 points, we're going to concentrate on what I call consistent stress points. One is payroll tax grouping. The other one is just going through the relevant contract provisions and when contractors may or may not be subject to payroll tax. The first one to do with grouping, as I said in the introduction slide, grouping was introduced in the mid-70s as an avoidance provision. The important thing about grouping, and for those of you who prepare payroll tax returns, you only get one deduction entitlement around Australia per payroll tax group. So if you have three employers in a payroll tax group, you only get one deduction entitlement, not three. The other thing is group members are jointly and severally liable for payroll tax of other group members. So if a business, if a business goes into liquidation or is deregistered, Revenue New South Wales can go look who the group members were at a point in time and ascribe joint and several liability to those entities. And that can be entities who haven't actually even got employees, but are still technically grouped under the law. So it's wide-ranging joint and several liability. The important thing is you can see from this table as a very simple example of the maximum amount of payroll tax underpayment if there were two employers grouped in New South Wales and didn't realise they should have been grouped, both paid over the $1.2 million wages threshold, both were claiming the threshold. You can see by losing one threshold in the column over claim, going back 4 years, there's a total of $211,000 payroll tax underpaid by one employer, by one employer claiming the full threshold entitlement. That's the maximum amount. A 25% flat penalty is about $52,000. So you can see on one issue, it's about $264,000. Now with ASIC searches and the like these days, State Revenue Office can probably find entities that are grouped through ASIC within 90 seconds, either searching by shareholders or directors. It takes no real audit evidence. And if you're in the group, this is a very simple $260,000 for the revenue authorities in New South Wales to assess without too much effort. And it comes as a big surprise, particularly to business owners or in organisations with CFOs and the like, that this amount can arise so easily through valid investigation by the revenue authorities. But not much investigation is required in these days of big data and data matching. It's different state by state, and as most people are probably aware, your threshold is determined on your Australian wages. If you're a member of a group, it's the group Australian wages. So it has an impact if you in states where if your group Australian wages goes above a certain level, you don't get any threshold. So the grouping is really important for how much threshold entitlement you get in each state. And if you look at this table, the general principle of revenue authorities going back in an audit, they will go back the current financial year and the prior 4. So right now in the current financial year ending 30 June 2023, they will go back to the year ending 30 June 19 to look at any grouping issues or indeed any audit issues. Next slide, please, Jamaya. There's 3 ways you can be grouped. First one is related corporations under the Corporations Act. Very straightforward. You're a holding subsidiary company, or your subsidiaries of a common holding company, but you've got the holding subsidiary company relationship. Subsidiaries grouped, holding companies group. And that can happen if the holding company's overseas, for example, and they have Australian subsidiaries. Very, very simple, very straightforward grouping ground. Second one is probably the worst provision that you will ever have in a revenue audit, and it's called the interuse of or common use of employees test. And that's if you've got people employed in one business rendering services to another business. There's agreement for the performance of those duties. Those agreements can be written or implied, express or implicit. It comes down to a matter of fact and degree on what the arrangements are. I won't run through these, but you can see the sort of words they use. An employee of one business performs duties in connection with another business, carried on by their employer, another person, employer. One person's employed solely in one business to mainly perform duties in connection with one or more other businesses. An employer has an obligation to provide services to another agreement under an arrangement. So typically you might see service officers, administration officers in the old professional practice partnership models in legal and accounting. But if you have a separate administrative group providing services into another entity, those entities can be grouped under this. Now, this, as I say, it's not a straightforward test. It's very hard. It's very hard to argue one way or the other, but it becomes quite a form of stress at a Revenue New South Wales review time if they say there is any use of employees and you need to prove there isn't. And it essentially comes down to the business arrangements, payments between 2 parties for use of employees and the like. So I won't dwell any more on that one. Jermaine, could I have the next slide, please? The third and most common way of grouping employees who aren't related corporations is what's under common control. Essentially, common control is where a person or persons, and you can see here that includes individuals, sets of individuals, trustees, corporations. The most common one is where those person or persons control more than 50% of more than one employer. So the easiest one is a company. If you have two individuals who own 51% in company A, and those two individuals own 51% in company B, on the face of it, those companies are grouped under common control, even though the other 49% in the two companies might be owned by completely different persons. It also attaches to whether not just share ownership, but voting rights attached to shares. So you can, if you go down this table, you can see where you might have control by a company, joint owners, partnerships, and trusts. The one thing to look out for trusts is that where a discretionary trust might own a business, which is an employer liable to payroll tax, each beneficiary of the discretionary trust is deemed to control the business. Sorry, each potential beneficiary is deemed to control the business owned by the trust. If that beneficiary owns a business in their own right, outside the trust, they're deemed to control a business owned by the discretionary trust. They control another business in their own right. Technically, you can group the two businesses. It's a very wide-ranging provision. I've actually seen a 30 to 40-page barrister's opinion, which is of interest to people like me and Darren, probably no one else, where the barrister set out to prove if you had discretionary trust owning shares in BHP and News Corp on the ASX, you could essentially group the world, which would be a little bit of a ridiculous result, but that's how wide these provisions can be. As I said before, you have what's called subsuming. If you have a business that is a member of one group and technically a member of another group, you join those two groups together. So it's a matter of tracing all the ownership interests, all the controls, and seeing where you might be able to break the links under the common control test. Again, we're having to go through this very quickly. This normally, as some clients on this call, I can bore them silly for 3 hours on these concepts. That Payroll Tax Australia website has a video on it on grouping, but this is grouping and contractors are the two biggest issues everyone faces in a revenue authority audit, and are the biggest amounts of money. Next slide, please, Jamar. Now, there is a de-grouping discretion. So if you're technically grouped, you can ask the revenue authorities to de-group you on the basis that the two employers are carrying on their business independently and are not connected, and it has regards to a number of matters: the use of employees, nature and degree of ownership, nature of your business, whether you're sharing resources or customers, financial relationships or dependencies. Back when I started doing payroll tax in the early 1990s, and someone would explain the discretion to de-group on the basis businesses are independent and not connected, they would say if you have a technical grouping of a mine in WA and a laundromat in Victoria, you would look at that and look at the nature of the businesses and the customers shared and those type of things. And that would be a typical example of where you would go and ask for a discretion to de-group. As I say, it's a big job having the discretion to de-group exercised. In New South Wales, it used to be a 55 questionnaire where you had to provide information to each of the questions and go through a process. It's a big job. But you're technically grouped and you remain grouped until the revenue authorities say we will exercise our discretion to de-group. If it comes time to a revenue audit and you haven't had them provide you with the written discretion to de-group, you're then under the pump to try and ask them to exercise the discretion to degroup back 4 years. When they harmonised the payroll tax in 2007, prior to 2007, you would have to, you could have Revenue New South Wales agree you should be degrouped, but Revenue WA would not agree. So you'd be grouped in WA, not New South Wales. And sometimes you saw employers right across Australia in every state and territory. Some would say grouped, some would say not grouped. That would mean you'd have different group Australian wages in different jurisdictions, and it could become a tad of a mess. What they did when they harmonised arrangements back in 2007, they said, we will let one revenue office take the lead on considering an application to degroup if an employer is outside, is in more than one state or territory. That revenue office will make a decision and then take it to all the other revenue offices to get their agreement or disagreement as to whether they'd be degrouped. And then the revenue officers together would make a decision. I know one of the participants on this call, we went through, it was an 11-month period from the time we put in a ruling request to the time that the decision by Revenue New South Wales and on behalf of a number of the other revenue officers said they would apply the discretion to degroup. So it's a long run process. It's across all jurisdictions. But as I said back up on my earlier slide, the financial impact of being grouped, not realising it, overclaiming the deduction is significant. The one thing is that the discretion to degroup is only for interuse of employees and common control. There is no discretion to degroup if you're related corporations under the corporations law. Next slide, please, Joanna. The other consistent stress point is contractors. And some of you, when Darren was talking about contractors and the exemptions, may be across it. Others may be wondering, well, what's all this talk about contractors? The first point to make is where an employer is receiving services, provision of services from a third-party contractor, that contractor is deemed to be an employee for payroll tax, and the payments to the contractor are deemed to be wages. So the first point in looking at contractor payments is that all contractor payments relating to the provisions of services are in scope of payroll tax. Generally, if I say that in a meeting, I can't hear any or see anyone here, there's gas saying that can't be right. And we'll have a look at how you get it out. GST charged by the contractors, not included in the amount deemed to be wages. WA is the only state that does not have contractor provisions. But WA might seek to say, particularly sole traders or non-incorporated contractors are an employee or a casual employee. WA doesn't have contractor provisions, but it has employment agency provisions. The contractor provisions in all states and territories and the exemptions are mostly similar. In the ACT, because of the reliance of employment agents and contractors in the government, some of the contractor provision exemptions sit in the employment agent provisions. Just another delight for people to consider. The other thing that is a common misconception is people say, yeah, I've looked at my contractors, but I have consultants, they're not contractors. It's not the label, it's the provision of services from a third party to the employer. You can call them contractors, you can call them consultants, you can call them any name under the sun. You have to look, is that person providing services to my business under what's called a relevant contract? And if they are, first off, my first point is all those payments are subject to payroll tax. I then need to go and look at whether one of these exemptions with the arrows next to them here apply. So services ancillary to the supply of goods. If I have a wet hire of a forklift and that comes along with a forklift driver, the payment in respect to the forklift driver or the crane operator is ancillary to I'm trying to hire the crane or the forklift. The most common area for exemption is services provided for 90 days or less in a financial year. So that will knock out if you have a plumber come to your business. Ostensibly, the plumber comes, the payment to the plumber is subject to payroll tax, but you're not going to have a plumber 90 days, more than 90 days in a financial year unless you've got a disaster. Day includes part of a day. And this is where it gets down to the modern world, as Darren was saying before. Modern arrangements are, you could have a contractor come on Zoom, speak for 5 minutes, say, yep, okay, I've got it. I'll speak to you again in another week. That 5 minutes technically is a day. How this is all proved and negotiations, if it ever comes up, is something that people need to look at a review situation. Services not ordinarily required by the business, or services required by the business for 180 days or less in a financial year. Typical example for the 180 days or less is they give the example of the ski fields and ski lift operators or the like, who are genuine contractors, not employees. They may well go over the 90 days in the financial year. It's a good ski season, but the ski season only lasts for, let's say, 120 days each year. They don't ordinarily require those contractors for more than 180 days in a year. Along with the 90 days, the second one is services performed by 2 or more people from the contractor. So you get PKF to come in, and you might have us in for 120 days because we're such delightful people at PKF. Ostensibly, we've gone through the 90 days. We don't meet that exemption, but because you have 2 or more people providing those services from PKF, that contractor payment's out. The other big one, and that applies in the building industry, all industries. So if you go through the 90 days, you have a look. Can we justify that there were 2 or more people providing the services under contract? And the final one is services approved by the Commissioner as exempt if you can show that the contractor provides similar services to the public generally. So that's, you get a large contractor. They might be with you for 90 days. It might only be one person from the contractor, but let's say it's for an IT project. That IT company is providing services to the similar service to the public generally. What generally happens in a review situation with Revenue New South Wales or other revenue authorities, they will ask you for a list of all your contractors. You provide that list, and then you go down and you knock out under the reason. That contractor had less than 90 days, that contractor had 2 or more people, and you get down to maybe 10 or 20 payments that you argue about. I'll cut it off there because we've still got a fair bit of content to go through. Again, great little video on the Payroll Tax Australia website about contractors, but grouping and contractors, as I say, 2 stress points, 2 points that Darren and I have probably been dealing with for over 30 years each. And it's a matter of wading through the circumstances, wading through the agreements, wading through ownerships and the like. Next slide, please, Jamea. Just quickly, the exemptions can't be applied if what we call as a contractor is an employee or a casual employee. Those payments are just payments to an employee, as Darren said before. Where it's an employment agency contract, you don't get the benefit of the contractor exemptions, except for some in the ACT. If you have contractors who are subject to payroll tax, where they provide both materials and equipment, these revenue rulings say you can reduce the contractor payment by deemed amounts. So for building industries, they might say for providing materials and equipment, the labour portion of the contract is 80%. These 2 rulings give you guidance on that. And when they get really nasty, if you get out of the contractor provisions, they may try to say, you're out of the contractor provisions, but we're going to argue that that contractor comes in under the inner use of employees test and they're grouped, and therefore the contractor is part of your payroll tax group and they pay payroll tax on $1 because they don't get any threshold because the larger business is claiming it. Final point is, particularly in the building industry, there are subcontractor declarations that cover fair work, payroll tax and workers' comp. If a subcontractor goes broke and they haven't met workers' comp or payroll tax, and as I understand it, fair work, I won't get into fair work because I'm not an expert on that. The revenue authorities can come to the principal contractor to recover the amount of payroll tax. But if the principal contractor has a subcontractor declaration, that in general will protect them from third-party liability where a subcontractor goes out of business and hasn't met payroll tax obligations for payments made under arrangements between that subcontractor and the principal contractor. With that, I'll let Darren get on to his next bit.
Okay, so the first part of the presentation has been about determining what the payroll tax base is. So we're looking at employees, contractors, grouped businesses to work out what your total pool of you need to include. And then you're working out the wages and you're working out what's taxable and comparing it to the threshold. So we're now moving into the calculation phase. So we're picking up all of our wages and you can see the definition of wages there, and it includes the payments to a contractor. So wages and contractor payments for those relevant contracts. And if you're an employment agent, the payments through the employment agent, they're all caught in that pool. Okay, and then we've also got to worry about this section 46, which is payments on behalf of the employer, third-party payment. So you can't get around it by having some other business pay them, right? It all gets included. So it's more of an anti-avoidance provision. You can access the OSL website. We don't need to do it today, but it talks about wages and determining what they are, keeping in mind the grouping, contractor, and everything like that. We jump to the next slide. So some of the common problem areas that we see that aren't quite done correctly. And for me, the key is consistency, is that you apply a method and you keep applying it year on year. And as long as you're including the right amounts of benefits and everything, it'll pass through a review, because you can have slightly different interpretations. But once you've chosen a methodology, you keep applying it, you don't try to change, then less likely to have issues. So the first issue is to make sure you're including fringe benefits. Sometimes they're missed. Sometimes you're not doing FBT returns and you have an ATO review and they say you've got fringe benefits. Just remember that you've got a payroll tax problem then as well, not limited to the FBT problem with the ATO. The difference here is that you gross up using the lower rate. You don't use the FBT return, but you can base it off the FBT return. Later, we'll get to the Australian wages, but we do need to allocate them between states and there's a basis for doing that. And because the FBT year runs from April to March, then the question is, well, how do you account for the other 3 months from April to June and each year? So they'll allow you to just use that FBT return for that calculation and assume it ends on 30 June. Again, you're just applying the consistent inclusion of that amount every year, and eventually it will catch up. So you do have to include a monthly amount, and the Office of State Revenue will allow you to include an amount monthly, and so you can do an actual calculation, right? Not many people do that. Actually, I don't think I've seen anyone do it. I don't know if you have, Ian. A monthly estimate. So for July to May, use 1/12 of the prior year FBT return. Then you catch up the balance in your annual reconciliation. And then you've got an annual calculation there as well. You can just put it in. So the main point being, fringe benefits are in, calculate them at that gross up rate and make sure you apportion them across the states and just look at how you get your information. Most commonly, it's the FBT return for 31 March and law of the 30 June year end. Go to the next slide, right? Another area that's missed, and because it wasn't always there, is the employee share schemes. Now, the confusing bit sometimes here is that not so much to include them or not, it's that the way they're included for payroll tax will not be the same as they are for income tax. and they give you two options to include them up front or to include them later. So you can do them on the grant day or the vesting day, and it can give you different values. So you're taking a bit of a punt on, if you do grant day, is that what's the value on the grant day? So it requires separate records, because most of the income tax ones are actually deferred. And then if the value turns out to be later, a higher amount for income tax, it doesn't matter because you included them up front. So whilst you're paying payroll tax early, you may pay it on the lower amount, but that's sort of forecasting what you think it's going to do. And of course, they're always going to go up. The other is to come closer to the income tax and cut down on your record keeping, is to look at the vesting day. All right. The concepts are very similar to the income tax, and it's whether you include them at that point in time. So just again, be aware of what your options are and how to value them and when to include them, and make sure you're keeping track of them. But you might want to, sort of have some sort of tally between the income tax and the payroll tax, so you understand what you've done and keep a record of that. If we jump to the next slide, please. So that's just how we value them. It's outlined there. And it's usually tied in when its vesting day is the 83A, which is your income tax. You can get refunds if it doesn't actually happen. The option's gone if you chose, especially if you chose up front, you can get that money back. Okay. And you can, if you choose to declare taxable value grant and the option is rescinded, before the conditions are met, you can deduct the value of the wages previously declared in the financial year the option was rescinded. So you can adjust for it. So you got to understand what you've done and how you're approaching it. If you jump to the next slide, please, Jermaine. The other thing to include is super contributions when they're paid or payable. Again, there's a cut-off issue normally. Our view is that the June period quarter super is not due and payable under the Apply Super Guarantee until the 28th. So you wouldn't be including it there, but then you've got last year's one that was included in this year again. So consistency is to put it through, but it's all employer contributions, whether they be salary sacrifice, whether they be lump sums, whether they be super guarantee, whether they're to contractors, because super can still apply for contractors and the like. But if they make after-tax contributions out of their pay, then you don't have to include those because they're not employer contributions. So you want to be able to differentiate between those. And again, as I mentioned, it's when they're paid or payable. Now, just on the topic that Ian mentioned before about access to information, with single touch payroll, everything's reported pretty quickly. The Office of State Revenue has access to that. And on the super guarantee, if we have large employers who are 1 or 2 days late with their super payments, we get letters from the ATO straight away. So they know straight away how much super's paid and it's late. So those employers have got a lodged super guarantee. Same with the Office of State Revenue. They already know how much super has been reported through single touch payroll. So they've already got a fair idea when they come out to review that whether you've included the right super amount, and it's only around the cut-offs that you might have some issues, but it'll be ballpark right. You jump to the next slide, please. Okay, so the other thing to remember is Australian wages. So you've got to be across every state in terms of those amounts and the contractor and every other provision. And then you've got to look at New South Wales for Australian wages and what it says Australian wages is. So you can have different outcomes across each state. And because Australian wages means different things in different states. And then the interesting thing is where employees are based. And so the Office of State Revenue has got some guidance on how to determine if an employee who lives in New South Wales but works in Victoria, where they're taxed for payroll tax, right? So they'll look at where the services were performed, they'll and things like that, but they'll also look at where they live. So you've got to look through all of the tests. So you look at the employee principal residence, the employer's address, where the wages are paid and where the services were performed. So you need to look through that to determine which state they fall into for reporting in each state. Okay, next. Back to you, Ian.
Thanks, Darren. All right, I'm sorry, we're just hit 2 o'clock. We'll probably run for another 5 minutes. I do apologise that we've gone over a bit, but as I said before, there's a lot of detail to run through in this, which I apologise for the amount of the detail. And I hope people have picked up some points as we've gone through, things they think we should go and look at that, or thank goodness we're doing that right, or we've got an issue we've got to have a look at. The final couple of slides is just to do with the annual process and reconciliation. That should say annual return process. I missed that, not annual refund. State revenue, we'll fix this before the slide goes out. State revenue authorities hate giving refunds. So that's meant to be the annual return process and reconciliation. So employers need to lodge the annual returns by the due date, which is generally the 21st of July. New South Wales, South Australia and the ACT give you to the 28th of July. It doesn't help you if you are paying payroll tax or are registered in the 21st of July states, because as Darren said before, you have to work, your threshold works out off what your Australian wages, group Australian wages are. So to the extent you're in jurisdictions that have 21 July and 28 July, you have to have all your information ready for lodgement on the 21st of July, because you need your final group Australian wages. If you're in New South Wales only, or you're a part of a group that's in New South Wales only, no other states you have till the 28th of July. So this is just something critical to look through. But as I say, if you're in a mixture of the states that have 21 and 28 July due dates, you essentially have to have all your data finalised for lodgement by the 21st. In New South Wales, ACT and South Australia, you can lodge a week later, but you do have to have that completed, the information completed by the week before. So I'll leave that table with you just so when the slides get sent out, you can see the due dates. Next slide, please, Jamaya. So we've talked about things, and the big thing about annual reconciliations, and the word reconciliation, what I say to any taxpayer is reconcile, reconcile, reconcile. The revenue officers have information sharing agreements with the ATO and they use them. So salary, wages, commissions, bonuses, allowances, directors' fees, all reported through single touch payroll. And in single touch payroll, you can now break up allowances, directors' fees and salaries. So the amount you put in returns will be data matched by the revenue authorities back to single touch payroll declarations to the ATO. FBT returns, very easy for the revenue authorities to get an FBT return, see how much has been declared, then look at the payroll tax return. Problem for them if you're in more than one state, how you've allocated that FBT across the states. But if you're only one state, it's easy for them to compare the FBT return to the payroll tax return. Reports and statements lodged under employee share schemes. Revenue New South Wales conducted a program this year where they actually went and compared to what employers had lodged by postcode, picked out New South Wales employees, looked at the amounts returned in employee share scheme statements lodged with the ATO to the amount declared in payroll tax returns, and then sent a letter and said, why is there a difference? And that difference could come down to is because you included the value of the option granted at the time of granting, not at the time of exercise or vesting. So there is differences, but they look at it, and as I say, they bring it down to postcode and state. So very specific data matching they can do there. Amounts expensed as super in if they can track that through single touch payroll, but if they ever look at if you're ever subject to a review, they will just ask for your accounts and say, why don't the two amounts match? Amounts that you declare for workers' compensation premiums should essentially match. There are differences, but there shouldn't be wild differences between your workers' comp premium reporting and your payroll tax. Amounts reported as payments to contractors, as say consultants and similar labels, They will just ask you for your accounts payable, and they will go through that line by line because they have time to do it. You don't have time to do it. TPAR in those industries that have to report to the ATO for TPAR, another excellent data matching source for the tax office. Then there's amounts on which apprentice and traineeship rebates are claimed, or in some states it's a reduction in the taxable value of the wage, in other states it's rebates, but they will go and look with the relevant training authorities whether your apprentices and trainees are appropriately registered. It's not just a matter of saying someone's an apprentice, someone's a trainee. There are registration requirements to get into those rebates or deductions, and those records are held by training organisations. So I guess what I'm saying is it's not like the old days where you could put in amounts for payroll tax, be relatively comfortable. Now, with the data matching that's available to revenue authorities, and they do use it, you really need to reconcile between amounts you declare to particularly the ATO to the amounts you're declaring to the revenue authorities, and make sure those amounts reconcile. Next slide, please, Jamaya. And you'll be saying, thank goodness, the final slide, listening to Ian. Not so much Darren, but to Ian. Some of the things that have been happening this year as we've come out of COVID and state revenue authorities are looking for money. The simplest thing that they've done is if people are lodging and paying payroll tax returns late, and when I say late, it can be 2 or 3 days. There is, and I've seen assessments where they will hit someone for a 25% flat penalty on a payment and return that's lodged 4 days late. So if they've lodged monthly return due on the 7th, not lodged and paid till the 11th, their system is set up, as far as I can see, to send out notices from the 10th. And that's where you've had, when I say consistently late, they generally will impose this 25% flat penalty where you have 2 months late payroll tax returns in a period. So really it's a surprise. It's draconian, but 25% flat if you've got $50,000 worth of payroll tax payable, that's 50,000, 2,500. Is it 50? Yeah, 2,500. You got $100,000 worth of payroll tax payable, and they apply this. It's a 25,000 penalty. So a big penalty can be lodged just for a few days late. They have had compliance data matching in relation to FBT returns, where they try and reconcile what you've included in your payroll tax return for against what you've lodged FBT. Generally difficult if you're providing benefits across Australia, how that's reconciled. But they do look at it, and as I said before, they've actually gone and looked at employee share scheme statements down to postcode and then asked why you may not have included amounts in the employee share scheme part of your annual return, because they can see where you've lodged employee share scheme statements. Now, it's just New South Wales. All the states, they're getting way more sophisticated data matching. Investigations are now being done electronically with pre-filled, not like the good old days where they would send you a blank form and you'd fill it out with pen and paper. Everything's coming electronically. Everything is data matched. Well, not everything yet, but they're moving and they're becoming a lot more sophisticated at it. And so I think, thank goodness for you all, that was the last slide. Thank you all for joining. I thank Darren for his input. And I'd like to say thank you. Good luck with your annual returns. As I say, if you need assistance, Darren and my contact details are there. You have your usual PKF contact details, who you could contact, or if you're indeed a client of another firm or another accountant or lawyers, you have those contacts. The final thing I will say, and PKF Marketing asked me to mention this at the start, This is the first webinar we've done under the new PKF Global branding, which you'll see on the slides. So for those of you who deal with us regularly, you'll be seeing a lot more of that branding in the future. And so again, I say thank you for your time. Sorry we ran over time, and good luck.